Today, we will talk about smart budgeting strategies. Although it may seem daunting, working out how to budget your money doesn't need to be hard. With these practical budgeting tips, saving up for your short and long-term goals can almost seem effortless. And these tips aren't just for those with a ton of disposable income. If you're wondering how to budget money on low income, we've got you covered with smart methods such as the 50-30/20 budget rule. 1. Track your expenses and analyze discrepancies. Both fixed and variable expenses can quickly consume your resources and hamper your financial stability. At the core of smart budgeting lies the ability to effectively track these expenses and analyze inconsistencies to minimize expenditure. For example, analyze your quarterly tax returns, and in case there are any discrepancies like underpayment or overpayment of taxes, a missing employee retention credit claim, or other missed credits, you must file Form 941X against your 941 tax returns form. Follow a comprehensive guideline that has the entire Form 941X process explained in detail, and file for any tax errors or refunds. Not only does it help you comply with corporate taxation standards, but it also eliminates overpayment and assists in missed credit reimbursement. Categorize all your expenses and leverage accounting and budgeting software or spreadsheets to maintain accurate fixed and variable expense records. This way, you can gain insights into your spending, identify areas where you can reduce expenses, and create your budget accordingly. While you may find it difficult to reduce your fixed costs, you can easily track variable costs and pinpoint any inefficiencies and unnecessary expenditures. Tracking your expenses and diligently analyzing any discrepancies is of utmost importance for small businesses, especially when considering the implications for taxes. Maintaining accurate records allows you to not only fulfill your tax obligations, but also gain valuable insights into your financial health. By identifying inconsistencies early on, you can rectify errors, prevent potential audits, and ensure compliance with tax regulations. For instance, suppose your small business operates in Colorado. Tracking expenses becomes vital, as you need to stay aware of the Colorado sales tax threshold to avoid any penalties for non-compliance. 2. Set smart financial goals. Establishing well-defined financial objectives with clear goals and vision is the key to your business's success in the long run. Whether your focus for the next fiscal year is to reduce your operating expenses, increase your revenue, maintain positive cash flow, or improve your profit margins, your resource allocation will vary depending on your preferences and financial objectives. When defining your financial objectives and setting goals, it's important to prefer a SMART approach: specific, measurable, achievable, relevant, and time-bound. When you set SMART financial goals, it becomes easier and more feasible to align these goals with your overall business objectives and develop a clear roadmap for resource allocation. However, it's also essential to frequently review your goals and make appropriate adjustments to ensure your financial objectives remain relevant to your evolving business needs. 3. Make generous projections for expenses. When you allocate a generous budget for your business needs, you provide yourself with the resources and financial cushion necessary to generate desired output efficiently without compromising quality. Besides, setting aside more funds than you anticipate can protect your business from unexpected challenges and enable it to achieve its monthly, quarterly, and annual fiscal goals. Moreover, when the actual expenses turn out to be lower than your budget projections, you can improve your cash flow significantly and save money for business expansion or diversification. 4. Be mindful of your sales cycle and predicted fluctuations. If your business belongs to the retail, tourism, hospitality, agriculture, event planning, or textile industry, you may experience fluctuations in sales throughout the year. There will be periods of high activity followed by slower times. That's where smart budgeting outperforms conventional budgeting techniques. Instead of relying on annual budgets and equally distributing them each month, it is essential to factor in associated expenses during peak and off-season sales. Focus on creating a financial buffer for peak sales season and minimizing costs during slower business months. This tactic will help you prepare for slower times and maintain a higher efficiency ratio of resource allocation throughout the year for sustainable growth. 5. Use technology to your advantage. We can't emphasize the importance of state-of-the-art tools and intelligent information systems for streamlining business processes and automating mundane tasks. However, among other core business functions, financial management and budgeting are key areas that need efficient and accurate record-keeping, tracking, and reporting. Fortunately, various cutting-edge tools are available for small business owners to simplify their budgeting process. Budgeting apps, software, and online collaborative platforms have made the intimidating task of financial budgeting much easier. These tools help you track your expenses, sales, and investments, generate financial reports, automate financial tasks associated with business activities, and provide standardized budgeting templates. AI-powered budgeting tools help generate comprehensive budgets by analyzing your expenditure history, predicting sales, evaluating market trends, and taking specific inputs from decision-makers. This way, business owners can save time and effort, minimize or eliminate human errors, and better understand their business's financial health. 6. Build an emergency fund. Economic downturns and emergency expenses, such as equipment repair or replacement, damage to digital assets due to cyber attacks, impromptu marketing initiatives, compliance fines, legal disputes, and natural disasters are akin to potholes along your business journey. As a small business owner, you must recognize that unexpected costs are inevitable in your venture. You must constantly be ready for these unexpected costs and devise a clear roadmap for contingencies. For this purpose, your smart budget must include a contingency fund that serves as a safety net and an umbrella, enabling you to address contingencies without straining your cash flow and increasing your business's resilience during challenging times and emergencies. Set aside a portion of your profits regularly into a separate account dedicated solely to covering unexpected costs or bridging gaps during lean periods. The specific amount earmarked for these surplus funds will depend on the nature of your business and the type of industry it operates in, but many experienced small business owners recommend having at least 3 to 6 months' worth of expenses in the emergency fund. What do you think of our video? Let me know in the comments section below. Before you go, please hit the like button and subscribe to my channel. Thanks for watching.